The market continues to look deep down into the red, at least for the large part, and we do get this based on the fact that Trump has confirmed Canada, Mexico and China all fall under the remit for some very large tariffs, and unfortunately there is no hope in terms of a last minute pause or in fact an extension. These are now in place as of today. But we noticed something that is increasing worries across investors is that both China and Canada will be doing a retaliation, and it isn't one that they are going to wait to see. These are going to be imposed ASAP, and we can in fact note that Canada's retaliatory tariffs are starting today, as highlighted by the PM. We also noticed that Mexico are now also going to have their own retaliatory tariffs, something that is really struggling to keep investors in an optimistic mood, and therefore we do get the extreme fear continuation in terms of the investor sentiment. Now, today's episode, we are going to look at 4 quality stocks that we do believe are very strong considerations for the portfolio right now. We're starting off with MSCI. Now, this one is pretty much flat over the last 12 months. Year to date, it's down 5%, but if you've been a longer term shareholder, you would be up around 902%. That is a massive outperformance against the S&P, whilst trading in the mid region of the 52-week range, with both Seeking Alpha and Wall Street calling this company a buy. It does also offer a dividend at around the 1.22%, and if we look at their earnings over the next 4, they do anticipate growth, all green, in fact the first 3 double digit, and they've also outperformed management targets over the last 4 quarters, 100% track record, which gives us faith they can hit their EPS target of just under $17 for the full year, meaning the company is currently valued on a forward basis of 35, and whilst there are no surprises, it does get an F overall. The company does trade at quite a significant premium to the overall sector. In fact, those that do pick up this company, you're paying 211% more. We're going to show you why it does deserve a premium and how much of a premium it truly deserves. We also just want to point out something maybe more useful than comparing it against the sector is that on the last 5 years, they've been trading at a valuation of 44.3. Right now, it does sit 22% lower, and one valuation metric we like to incorporate in our analysis is comparing it against the expected fair price. Now, bear in mind, we're not looking at this model in isolation. We're going to run through our own process shortly, but in essence, the blue tunnel does tell us the expected intrinsic value, and right now the company is sitting below that. There's disparity between even the lower end. That is a severe undervaluation signal, and the other positive thing to note is that over the last year, the expected value of the company has been increasing, moving in the right direction, which is something you always want to see companies you own be worth more and more over time. The second thing to point out in terms of undervaluation, as we've already highlighted, it does trade at a lower forward valuation than the last 5 years, but another indicator here is dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year average, 1.27 above 1, again, many undervaluation signals today. The other thing is looking at their growth, where they get a B-, year on year 13%, over the next 12 months anticipated 10. That is above the mid-single digit of the sector at around 6%, and not that far off their own historical figures of 13 and 12% respectively. In terms of the earnings per share, well, over the next 3 to 5 years, they do anticipate it to grow at 11.2. That is above the sector at 10.1, but slightly under their own historical figure of 13.5. In terms of profitability, they get an A-. Now, gross margin sitting at 82% is significantly above the sector at 60 and pretty much in line with their own 5-year average. Bottom line looking very strong, 39%, well above the sector at 22.5 and pretty much in line with their own 5-year again. In terms of cash, this company does generate a significant amount from their operations, 1.5 billion when the sector comparative is much lower at 147 million, and we also notice over the last 5 years they have on average generated around 1 billion, so as time has gone on they continue to generate more and more. In terms of institutional ownership, it does sit around 90%. We get 4.7 billion worth of sales over the last year, but institutions have bought more, 6.5 billion during the same time frame, but they've also bought nearly twice as much in the most recent quarter, so very, very obvious institutions very bullish on MSCI. In terms of our valuation, our intrinsic price today comes at $709, as we can see, derived from the DCF model. Now we have the free cash flow year on year, average growth at 21%, Moving forwards, we've gone 14%. That is more conservative than even analyst expectations, but we have a low, medium, and high. Remember, numbers here are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for MSCI or any others. But based on 14% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, $709 indicating 25% upside. Now, just to be transparent, we will in fact show you at the lower rate of 12%, $609 upside, although marginally at 7%, and for those that believe we should be a lot more optimistic, at 16%, $823 indicating 45. Now, as always, we take through the medium rate, which today is 14, and we always apply a margin of safety, starting off at 10%, executing on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, a buy up to $638, then we keep going till it's near the current trading price, and pretty much right now for MSCI, a very high quality company. When we've done deeper dives, we've looked at the underlying metrics, 20% MOS, Wall Street themselves see 20% upside over the next year. Their price target $682. And as always, give us your thoughts about each one of these, whether you agree that they are a buy or maybe a hold or a sell. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning completely for free to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to undervalued stocks for the month of March, lots of information as well as the upside that Wall Street themselves see over the next year, and you can grab a recently released copy of 32 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're covering is Salesforce, down nearly 10% over the last year. Year to date down 15%, but longer term shareholders over the last 10 years up 342%, massive outperformance of the S&P, trading in the mid, moving towards the lower end of the 52-week range, a double buy again from seeking alpha in Wall Street, and a dividend yield on offer at 0.55%. In terms of growth, well, they do expect that for every single quarter over the next year. However, over the last 4, they have missed one of their earnings, so a 75% track record. And right now, based on the EPS for Jan 2026, the company trades at a valuation of 26.3. Now, they get an F on valuation. When we do compare it to the sector, again, one that we do believe is worth a premium. In fact, you're paying 19% as such. In terms of the last 5 years, they've been trading at a much higher rate, 42.3. So right now, they are trading at a 38% discount in relation to the last 5 years. If we take a look then at this model, what we can in fact see is there is disparity between even the lower rate and where it currently sits. Again, another signal, as we said, of severe undervaluation, and something that is confirmed when we do take a look at the forward P, 25.6, much lower than their historical valuation at 32.7. If we would take a look at their growth, they do get a C, but we do notice year on year and over the next 12 months, 9% growth to their revenue, sector in comparison at the mid-single digit. However, over the last 5 years, on average, they have grown at a much faster rate in the double-digit region. EPS, well, that is expected to grow at 17%, above the sector at 15%, although coming under their own 5-year at 20.3%, and profitability does look very strong at the A+. Gross margin 77%, above the sector at 50%, but also above their own 5-year at 75%. Bottom line 16%, well above the sector at 4%, also well above their own 5-year. So not only revenue increasing over time, they are working on their efficiencies, with their margins also getting a lot stronger. Cash from operations, very, very high, 13 billion, when the sector sits at 106 million. And in fact, over the last 5 years, it has sit nearly half of that at 7.3 billion. Institutions themselves, with their 81% ownership, have been selling around 23 billion over the last year, buying a lot more at 31, but also buying more in the most recent quarter. So again, very similar to what we saw for MSCI, institutions clearly very bullish on Salesforce. Now our valuation gets to $372 today. As you can see, we've used a 12% rate, giving us an intrinsic price of $371, which means 30% upside, 13 if you were to use the 10% rate, and 49 if you were to use the upper end. So in terms of a margin of safety for CRM, as we do in fact keep going today, you are getting quite a nice, not 25% just yet, but between 20 to 25, with Wall Street very bullish in terms of their price target. They see this at $385 over the next year, translating to 35% upside. We then move on to Broadcom, which is up 34% over the last year. Year to date, they are down around 18.5%. In fact, this was one of those stocks that we actually said is a sell when it was trading near its 52-week high. Now it has pulled back in the midpoint of the 52-week range, down nearly 20%. We do see this one as a strong contender for a very good position in the long-term portfolio, up 1,413 over the last 10. Massive outperformance of the S&P, a strong buy rating from Wall Street, a buy from Seeking Alpha, and a yield on the upper end so far today at 1.3%. They also expect double-digit growth over the next 4 quarters, whilst also outperforming over the last 4, giving them a valuation right now on a forward-looking basis at 29.5. In terms of valuation grading, another F, given they do trade at a premium to the sector. In fact, you are paying 33% more, and we also actually notice when you look at the last 5 years, they've traded a lot lower, so you're also paying a premium to how they've been valued over the prior 5 at 44.2. Something that is also reinforced when we look at this valuation metric. Whilst the blue tunnel has been increasing over time, we do notice a lot of disparity at the upper end rather than at the lower end, which could signal here severe overvaluation, and the same that is reconfirmed when we do look at their forward PE. As always though, these aren't models that we look in pure isolation, we use it as part of our overall thesis. Grade, they get a B+. Now what we have noticed, year on year, their revenue is up 44%, well above the sector at 5, well above their last 5-year average of 15, so you can see why perhaps they are trading above their 5-year valuation, where typically we actually see the opposite, companies trading lower than the last 5 years, but also producing results that are lower than the same period. In terms of over the next 12 months, expected to grow at 26%, well above the sector at 6.5%, but also well above their own 5-year at 12.8%. And if we do get to the EPS, that is anticipated to grow at 22%, well above the comparative for the sector at 15%, but also above their own 5-year at 14.8%. In terms of profitability, it sits at A+, 75% gross margin, sector at 50, their own 5-year a little low at 74, bottom line 11%, that is above the sector at 4, but we do notice over the last 5 years it has sat much higher at 24.2, and in terms of cash generated from operations, 20 billion when the sector comparative sits at 106 million, and their own 5-year also sits lower at 15.3. In terms of the institutions, 77% ownership, 30 billion worth of sales, but a massive amount more in terms of buyings at 194, and we also notice nearly twice as much buying in the most recent quarter, so these companies so far are very bullish in the eyes of institutions. Bear in mind though, this data is from the trailing 12 months. In terms of intrinsic value, we get to $228. Now we have used a 20% growth rate moving forwards. If you believe that 15% is more appropriate, this would mean downside to 16%, but based on the 20 that we have today and their average over the last 10 at 48, this indicates 22% upside, and for the more optimistic at 25% to the free cash flow growth, 73%. So with $228 and the current trading price, we do get a nice margin of safety, not at 20% just yet, not far off, but sitting somewhere between 15 to 20, with Wall Street themselves very bullish, $242 price target. That translates to 29% upside, and let us know if you see these as a buy, hold or sell. We then move to FedEx, which is up pretty much only 1% over the last year. Year to date down nearly 12%, and over the last 10 years it is up around 44%, but bear in mind will depend at which point you did buy this company over the last 10 years. In fact, if you did buy it near the COVID drop, it was trading around $120, so you would be up pretty much more than double the current price. We do also notice it is trading now near, or in fact right at, its 52-week low, and a triple buy rating across the board. The first one today, Seeking Alpha, Wall Street and Quant all believing one for the portfolio, and they offer the highest yield at 2.1%. In terms of earnings, well, they also expect over the next 4 quarters to be double-digit growth, and over the last 4, they have outperformed on 3 of them, 75% track record, with their May 2025 EPS estimate valuing this company on a forward basis at 13.5. Now, they get a C+ overall on valuation, but they do trade at a discount to the overall sector, in fact 27%, and also marginally lower, around 2%, than they have been valued over the last 5 years. When we then run it through this process here, well, in fact, we can see right now sitting towards the lower end, that is a signal, as we say, for undervaluation, and it's reconfirmed given the forward P does sit below the 5-year, and also the current yield at 2.2 is above their own 5-year at 1.92. Then we get to their growth, which is a C. Now, year on year and over the next 12 months, pretty much expected to be flat, whilst the sector median, as we can note, and in fact their last 5 years, has sat around the mid-single digit point. In terms of EPS though, that is where they are expected to outperform, 13.3% over the next 3 to 5, sector at 11.7, and their own 5 years slightly lower at 12.6. Profitability looking good at an A+, gross margin 27%, slightly below the sector at 32, slightly above their 5-year at 26. Bottom line 4.5%, lower than the sector at 6, but a little bit higher than their 5-year at 4.1. Cash from operations, whilst very strong at 6.81 billion in comparison to the sector at 380 million, we can see over the last 5 years they have generated a lot more cash at 8.5 billion. Institutions hold around 85% ownership with nearly 5 billion worth of sales, but around 6.5 billion worth of buys, and we can see, at least in the most recent quarter, a little bit more buying than we did in fact get selling. So our intrinsic value today comes to $310, and as we do in fact notice, there is quite a substantial margin of safety. You're getting 20% around the $248 mark, with Wall Street very bullish, similar to the previous companies today. $324 price target, translating to 30%. As always though, do give us your thoughts whether you agree these are must buys at the moment. Nice margin of safety, nice upside, and overall some high quality companies. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells. We have been buying even today given the volatility, but as always, have a great day and we'll see you all on the next one.